presentation.
So first of all, many thanks for staying until the end, and I really promise it will not be longer than 15 to maximum 20 minutes with the questions. I'm also happy, to be able to give a second contribution to insurance today. And M&A insurance is maybe like cyber, another product that is quite new, in particular in this part of the world. Generally speaking, M&A insurance describes, insurance solutions that are available for the seller or the buyer in a transaction, so in a sale and purchase of shares, assets, property, or also intellectual property. I will now focus my speech mainly on the, let's say, the main product, the product that is most established, who is known in the market as warranties and indemnities insurance, or also reps and warranties insurance in the United States. It is actually I just will jump over this. It is actually insurance for unknown risks. Warranties and indemnities insurance can be structured as a buyer side or a seller side insurance, and it does cover losses arising from a breach of warranty or claims under an indemnity. So W&I insurance does cover risks that are unknown at the inception of the policy. The policy, as we will see later on, can incept either at signing or closing of a deal, which is, of course, not always the same day. To say there's two types of policies. There's the so-called buyer-side policy. I have to say that about 80% are buyer policies today. Those are first-party damage policies. So the buyer of an asset, for instance, of a property, a hotel, or of a company, for instance, a commercial company in Hungary, the buyer is insured as a first party. So whenever if the buyer suffers loss, he can go directly against the insurance company. The seller can also be our client, so the seller is basically, on the seller side, it is a third-party liability policy, meaning that when the seller does get a claim from the buyer or a third party, he can come to the insurance company, the insurance will defend the claim and will settle the claim and pay the loss in the end of the days. So W&I insurance, that's maybe important, also includes coverage for reasonable costs related to the prevention, mitigation, investigation, defense and settlement of any covered claims. Now you may ask yourself, of course, what are the key advantages? That's maybe my sales pitch from my side. Why would one want to buy this policy? On the seller side, the seller, of course, he seeks a clean exit. So the product has started about 15 years ago at Lloyd's and then has spread, first of all, in the more English-speaking common law jurisdictions. So in the UK, in the US, in Australia, it's a very, very common product, and about 25 to 30% of the transactions are insured. So the most common buyer of this product is actually a seller, an investment seller, so like a private equity fund or another fund. For them, the clean exit is absolutely important. So meaning having the option to transfer part of the risk at closing or signing means for a private equity fund, for instance, the ability to close down the fund, to wind down the legal structure, not to have, to wait for any money until the warranties expire, which can be 5 years or 7 years, which can be quite long, but basically get the full sales proceeds right away. It is an alternative securitization. So why having money, usually 10, 20, 30%, sometimes the full purchase price, blocked for a number of years on an escrow account, where we have heard it many times during today, the interest rates are very low. So basically the cost of establishing and maintaining and administering the escrow account is more expensive than buying insurance. So it does basically give you a good tool to right away substitute an escrow account or another means of securitization like a bank guarantee by insurance. It's also attractive in a bidding process. From a seller side, the seller can, of course, as we call it, dress up the bride. So we see this quite a lot. The seller is basically preparing the data room, and already within the data room there is a seller side insurance policy. So the bidders will basically see that they get additional protection than just having the seller as a debtor. In addition to that, they would get also the insurance behind it. Sometimes what happens then is the so-called seller buyer flip, meaning that one of the bidders will be chosen. He will basically buy the target company, and then the insurance policy is flipped. I mean, at the moment when the buyer buys, the seller side policy will be converted into a buyer side policy and protect the buyer for his own loss. It can still be the seller that pays the policy, because it's kind of like a good sales tool and a possibility for him to reduce his own liabilities and also possibly increase the sales price. For the buyer, it's a first-party damage policy, as I said, so there's a key advantage. The buyer can go directly against the insurance company. Now, here you had the chance to mention 2 brokers, insurance companies. There's of course more. There's about 12 to 13 insurance companies that offer this product in the London market. Locally, let's say in Europe, there's about 3 to 5, depending on how you count. There's 5 in the US. But all of those insurance companies, and if I talk about A&V, we're basically underwriting on behalf of Lloyd's, so it's the Lloyd's rating. All of those insurance companies, including Lloyd's, have a rating of A or higher. So you'll typically find, of course, AIG, Zurich, the big names, and then various Lloyd's syndicates or consortiums that sell this product. So it's an excellent debtor. That's another very good advantage. A lot of times the seller may disappear. It may be just a fund, we have heard in Liechtenstein, it may be in Luxembourg, it may be in Cyprus. You may not know who is behind this fund or structure, so it's very unlikely that you can still actually go against this seller after a few years. Or sometimes it's just also individuals. I mean, in particular in Italy, where we've done a lot of deals last year, a lot of our clients were private persons that have built up a business, and in their second or third generation, they're selling the business, same in Germany, and they say, I have saved money, I've basically built up that business, and I do not want to risk to lose part of that business. So, I mean, there's also a reason for both seller and buyer to buy the policy. It is often a tool that does speed up the process, that does speed up the sales process. Sometimes also gives a solution. If the seller, for instance, is not willing to give any warranties, the product can help. Sometimes the seller cannot give any warranties. Let's see, the seller could be a state, could be a liquidator, could be a receiver. In all of those cases, basically through the policy, of course, the seller can kind of give a standard set of warranties. Of course, we're here to assess the risks, so that will not make it a very buyer-friendly risk, but just a balanced set of standard warranties can be insured in such a case. The underwriting process, I just want to, as I said, promised it will be short, and you can all receive or see that presentation later on. It's a two-phase underwriting process. Generally, we get contacted by a broker, like we've seen 2 brokers here in the room today, and the broker sends us a submission. We'll get back to the broker within 1 to 2 days, so 48 hours, and tell the broker, yes, we can insure this deal. Those are the documents we need. Those are maybe the restrictions. This will be the premium. So either we can already give an exact premium. We can say the policy will cost 75,000 euros, for instance, or we can give a premium band, and we will indicate next steps. Also, then the broker should, or usually does, that's the broker's job, now we'll get 3 or 4 different options for his client, and then discuss with the client which one is the best one. Price, premium is of course an argument, but coverage is a lot of time more important for our clients than premium, and of course also the insurer and the execution. For most brokers, actually, their main risk with insurers is execution risk. So they need to be absolutely sure that their insurers, their partners, have people on board that know M&A, that can follow the process, because what you really don't want is, that all the parties are around at signing or closing at the table, and the deal does not happen or gets delayed because of insurance. The opposite should be the case. Obviously, insurance should make the transaction faster. How long does the whole process go without going into details? Phase 2 can take anything between 3 days and 2 weeks. Usually it takes about 10 days, depending on how complex the structure is and how much time we have. During this phase 2, we are actually, we're not doing a due diligence. We're not, we have finance specialists on the team, we have legal lawyers on the team, but we're basically assessing existing due diligence, whether it's vendor due diligence or buyer due diligence, and based on that, we will also negotiate the policy and issue the policy within those 5 to 7 working days. It's a one-off policy. So it starts at closing or signing and will then last for as long as the warranties and indemnities last. So typically business warranties and indemnities, on the employees, for instance, on the stock, on whether certain machinery works, things like that, are given anything from 12 months to 36 months. And then let's say more conceptual warranties like title, capacity, tax, environmental are usually given between 5 and 7 years, but will in any case try to match the legal statute of limitation. So the policies can last up to 7, some insurers even often offer 8 years, and we can, for instance, if it's matching a legal statute of limitation, even grant coverage up to 10 years. Not doing that frequently, and it's also a little slightly more expensive, but like market standard is 5 to 7 years without any problems. So maybe what does the, goes on here. Those are the documents, you can see this later on, the documents that we basically need for our own assessment. Very important is of course the due diligence and the share purchase agreement or asset purchase agreement. The sooner we get that, the better. We will not negotiate the agreement, but we sometimes, as we're very familiar with those agreements, and we see more of them than many of the lawyers, we see about 300 to 500 a year, we will get some input on that. Regarding the premium, you can see this in detail later on. Just as a general rule, the premium for such policies is right now oscillating between 1 and 2%, not of the transaction value, of the sum insured, which again reflects the seller's cap, so the maximum liability under the share purchase agreement, which usually is between 10, 20, 25%, really depending on the deal parties, on the country, on the industry, but it can also be full purchase price. In some, let's say, very straightforward property deals in some jurisdictions, it can actually also be lower than 1. So we have already done policies for 0.9, 0.95. But I would say between 1 and 2 is really the option. So it's quite a cheap cost if you, as a seller, can think that you will receive your money right away, 100% of the purchase price of the consideration. And as a buyer, you will have the possibility to go against an insurance company, usually A-rated. We had some examples. You can also read them maybe later. I just wanted to show that we already did deals, and also the industry. It's not just us, so it shouldn't be just a sales speak for myself, but the industry is doing the deals in CEE, CIS region. We did, for instance, one in Hungary. It was an office building, so a property deal, where there were some issues related to title, and some of them were quite severe. So what we did in this particular deal is there was a split insurance solution. So First Title, who is quite a known title insurer, did insure the title of this office building in Budapest, and we insured the rest, so all the operational and tax warranties. We also very recently did a deal in Serbia, which was for various reasons slightly more complicated. It was also in the food and dairy and beverage industry. So there, of course, the degree of due diligence was very important. It was also important to get management involved. So we did discuss a lot of open issues with the managers, and some of the old managers of the old structures actually were again active in the new management and were also shareholders, minority shareholders, but we did get them involved. We also did deals in Poland, several ones, most on the property side. The one example I have here is a classic one, it's an industrial park. This one was in Lodz, but we also do shopping centers, hotels, and even larger residential properties. I also have the Romanian one here that actually I did do with the help of George, that does sit here. Of course, I cannot disclose any names, but it was an investment in Hungarian investment into an energy project in Romania. Very well done, and also shows also a good example that we can also that the market can also provide insurance for smaller and mid-cap deals. So it's on the maybe that's an interesting one also. What kind of deals can be insured on the upper end? Because the market is growing and growing, and new capacity is flowing into the market. The market can provide currently about a capacity of 600 to 800 million euros or US dollars. And there was one very, very large deal last year, whereas that an American tech company, one of the three big ones, I'm not going to say which ones, did buy a very famous computer game, and they bought insurance for 600 million euros. Obviously, that was not one insurer, that were basically most insurers were in this layered program. On the lower side, I would say, transactions of 5, 6, 7 million seeking an insurance protection of 2 million or more can easily be insured. Right now, no one in the market offers a real product for SME, but I'm sure that's going to be available on the market quite soon as well. That's how we deal with our claims, so I don't want to say too much about this. Maybe just one thing as the last slide, the market is booming. The M&A market itself is growing. We believe will also grow very strong in this particular region of the world, so CEE, CIS. And the sale of M&A insurance is growing very much so. You have the 2013 figures on there, but basically one of the other large brokers not present here, Marsh, just recently published another study that the growth for 2014 was 51%. 51%. So it's very fast growing. And obviously there are some major markets in Europe like the UK, Sweden, parts of Scandinavia, where every deal maker, every lawyer will have that on his schedule. But not so yet, I think, in the CE and CIS region, but I don't see any reason why, for banks in particular that are present here, and lawyers and M&A advisors, this should not be just taken into consideration as one other good alternative to other securitization. So I thank you, and I don't know whether anyone still wants to ask a question. I'm very happy, of course, to respond to it if that's the case.
Thank you very much. We look forward to having you.